All right, we're doing calls of the day now. We have Oppenheimer today on Netflix, Weiss. They say buy the pullback. Bull case through 2026, outperforms $725, the price target. 621 is where it's at now.
Yeah, like in addition to the market, there's also an article that was out there that said Amazon is undercutting them on their ad sales on the pricing. Look, Amazon should undercut them because they don't have the content. They've cut back their spending on content. So Netflix, to me, is still the best. And if you're going to an ad model, that's going to get more eyeballs. So you're not going to get that pricing pressure from the advertisers. I still like it. It's just a tough market for these stocks, for anything tech related, even though this is more consumer related. And by the way, as the consumer continues to cut the corners, consumer continues to not go to movie theaters because those have gone way up those ticket prices. This will do very well. So my advice is just be patient.
All right. Belsky, you own it too.
Yeah, we love it. And here's the reason why we love it. It fits this description of our consumer staples in tech. And it's the Kleenex of streaming. It works thematically in terms of cash content and consolidation. And now going into live sports, I mean, this is a juggernaut. You have to own it.
Is that a Canadian term, Kleenex of streaming?
I got a call, Jenny, on Whirlpool today. It's by Bank of America, which says underperform. They had no rating on it before. The price target's $88. They say there's a risk to guidance. What do we think here about the stock that you own?
I think it's really short-sighted. So the reason that, or rather, you may recall, we bought Whirlpool and we bought Stanley Black & Decker at the same time in May of 2023. And the investment thesis was roughly the same on both of them, which was as interest rates come down, as the housing market returns, as people have to spend on building and appliances, both of these stocks should benefit. So Stanley has played out much more quickly than Whirlpool. And you can see that. I mean, they just reported last night. Numbers were great. Stocks up 8% today, so hooray for that. The investment thesis remains the same for both. I think Whirlpool is just a slower burn because you really have to see those interest rates start to come down, and you have to see the housing market volumes recover, and then the appliances start to follow that. So I really disagree with this. I think you just sit there and be patient. But here's the thing. On Whirlpool, you're getting a 7% dividend yield. They just announced earnings last week. They announced $12 of earnings. And by the way, that was a little lower. Like the range had been 12 to 14 and they lowered it to 12. $12 covers a $7 dividend, 7% yield. You can just sit there and wait until this recovers and get some really nice tax advantaged income in the meantime. I think it's a really bad call.